I'm pleased to say that the upcoming panel, I think, is going to bring together a lot of the threads that you've already heard a lot about today. Things like globalization, trade, inequality, winners and losers out of the globalization process. And I'm very pleased to say that we have a trio of experts on this subject. To my left, we have Alan Krueger. He is, of course, professor of economics and public affairs at Princeton University. We also have Karthik Sankaran. He is director of global strategy at Eurasia Group. And then finally, we have Branko Milanovic. He is a professor at City University. He is also the inventor of the infamous elephant chart, which was hailed as a chart that explains a lot of what's happening in terms of globalization and the spoils or lack thereof being shared around the world. So the name of this panel is, of course, The End of Globalization, so we should probably start there. Do we actually think that globalization is moderating in any way? Is it going in reverse? And if it is, are we talking about trade? Are we talking about immigration? Are we talking about capital flows? Alan, you're in the hot seat, so let's start with you.
Sure, and thanks very much for inviting me. I think that globalization is moderating. I think that's occurring for a couple of reasons. And I think you see it pretty clearly in the data. If you look at the growth in world trade, it's slowing down. And this year, for the first time in decades, trade will probably grow more slowly than GDP worldwide. So that's a sign, I think, of moderation. Also, apart from the enormous wave of refugees, which I think is a humanitarian problem and a crisis, we're seeing a slower rate of immigration in much of the world. And I think that part of the moderation, I wouldn't call it the end, first of all, get that off the table, but part of the moderation is because the forces that caused such rapid globalization were naturally not going to go on forever. The fact that China became much more integrated with the world economy, or that Eastern Europe and the fall of the Berlin Wall, those are one-time events which had a major impact on trade and created lots of opportunities and caused a lot of disruption around the world. But that was not going to go on at such a high rate for so long. And then secondly, I think we're seeing equilibration take place. So for example, we are seeing something of a manufacturing renaissance take place in the US. We're seeing job growth in manufacturing, in spite of a lot of headwinds, a stronger dollar more recently. And we're seeing companies that are reshoring work. And I think there are many reasons for that, but one of them is the fact that wages haven't totally equilibrated around the world by any chance, but they're a lot closer. And the cost advantages of locating your facilities in China, especially given that the infrastructure there has been stretched so much, I think are not nearly as great as they were a decade ago. And I think many companies are finding it advantageous to bring their supply chains back closer to home. And that helps in a number of respects. It, I think, provides more stability and higher quality. And I think the forces of equilibration are going to continue to take place. So I think that trend will continue. So I think it's likely we'll see a continued moderation. Then the last part of this, of course, is something of a backlash occurring, most obviously with the Brexit vote in the UK. And I think that potentially could be a factor going forward as well.
Karthik, Alan just laid out a smorgasbord of potential signs to look at when it comes to globalization moderating. What are the most telling signs for you?
I mean, a couple of things. One, obviously, is the political backlash in the developed markets, and it's not just Brexit, but arguably the Trump candidacy, the fact that he led the first 30 minutes of the debate with trade, which is the party's actually seen as having had the most impact, I think, is one thing. I'd argue that, and this goes to Branko Milanovic's graph, that the gains of globalization have, to some degree, led to a backlash against globalization among some constituencies in developed markets, but it's actually probably increased the appetite for globalization because you've had that concomitant increase in incomes in China and India in particular, so there's more openness to the world there. But I think the other thing that's interesting is not just at the mass level, so to speak. It does seem as though, to me, that elite opinion is turning against some aspects of financial globalization in particular as being potentially destabilizing. And over the last 24 months or so, you've had a series of kind of the great and good of international macro, Olivier Blanchard, Hélène Ray, Claudia Borio, come out and say that the combination of very large capital flows, floating exchange rates, and completely open capital accounts may actually be more destabilizing than stabilizing. So, from the point of view of this audience in particular, I think that's something that I would be looking at, see where the intellectual debate goes on that, because I agree, globalization may moderate, it may also look somewhat different with multiple hubs. The one that I'm curious about is whether financial globalization is going to continue to look the way it's looked over the last cycle.
That's a great point. Karthik, you touched on the idea that the spoils of globalization haven't been equally shared in some way, and that's fueling some of the discontent that we're seeing now. Branko, you have written a lot about this specifically. Give us your take.
Well, yeah, you're right, actually. Let me just go a little bit back in the way that the so-called, as you called it, infamous, but it's actually famous chart was created. It's actually based on really long work that was done over like last 15 years. It's actually based on household survey data on incomes of people around the world. So my objective was not really to look at really sort of to produce a chart like that. It just turned out that the chart, when I first did it in 2012, showed this unusual shape that, of course, we all expected but have not seen it. And it's a shape where you have very large real income gains around the middle of the income distribution, mostly in Asia, not surprisingly. It's not only China, but it's India, Indonesia, Vietnam, and so forth. And then you had really very slow growth, not negative growth, but relatively slow growth in the lower parts of the income distributions of the rich countries. And there I would like to single out three really large countries, like US, Germany, which is actually not often mentioned, but Germany had actually, in terms of real incomes, in the bottom 50%, very, very slow, almost zero growth. And then Japan also, a country with very slow growth. So, and then, of course, basically you had at the very global top 1%, very rapid growth. So that actually what gave to the chart its distinctive feature. And it actually basically highlights the fact that the gains are not evenly distributed. Well, of course, they would never be evenly distributed. It's not actually that any particular group, although there are groups, of course, in these surveys who have gone worse in absolute terms, but even on that particular chart, the bottom is still positive. So, I mean, if you really were to believe in each percentile being as an individual, you can say it's a Pareto improvement because everybody's better off. But clearly, some people are just not happy to be just better off if others are getting much, much better off than themselves.
Does this speak to something about human nature? It's all about relative gains versus absolute gains?
Yeah, I started thinking about that because actually when I put myself in that sort of a point, that kind of a low point, what I see is actually I see people from Asia maybe willing to do the same job that I'm doing for much less. So that's really kind of a threat to me. And then I might get upset when I see people from my same country as I doing much better than I. So I think that's kind of an interesting position that people are in.
All right, speaking of Asia, if we're talking about winners and losers in globalization, then are we really talking about China, essentially, which has sort of muscled in on the global stage and changed pretty much everything? Alan?
Well, China probably represents a quarter of your graph.
Yeah.
So you really can't talk about these issues worldwide without looking at China. And China, I think, has had a profound effect on parts of the U.S. Studies that have looked at what happened to manufacturing in the Midwest, which specialized in industries that China subsequently entered, found that they've struggled much more. So I think China has certainly had an impact, but other things have mattered in manufacturing as well. Just technological progress, productivity growth, I think is probably a more important factor. But we don't make trade agreements involving technology. We make trade agreements involving other countries. And I don't think we've done enough to help people make a transition who were dislocated from China's entry into the global trading system.
All right. Well, if we agree that globalization is moderating in some way and that a lot of this is being fueled by inequality in terms of its gains being spread around the world, can globalization be managed better in some way? And if so, who gets to make those decisions? Karthik?
That is very difficult because I think what you're asking people to do, and this is the famous Danny Roderick trilemma, you're asking people to give up some element of sovereignty if you want to manage things better. And the part that I've focused on more is, recently has been just exactly thinking about capital flows and the way they operate. It was very interesting that there are two arguments about how you could do this. Some people think you shouldn't do it at all. Some people think you should, there's been an intellectual rehabilitation of capital controls. And then Raghu Ramarajan came up with this third idea of kind of a global monetary policy council that signs off and looks at spillover and says, okay, you can go ahead and do this. You shouldn't do that because the nature of the spillovers. For what it's worth, my own view is that the third one is the least likely, simply because it involves sharing sovereignty versus something like capital controls or some version of a transactions tax like the IOF in Brazil actually retains sovereignty. So I think it's going to be, if it'll be managed nationally, not internationally. It's my own sense.
And what about in terms of, people talk a lot about targeted measures for globalization and managing it better. What's the actual record like in terms of those targeted measures? Have we seen success in those efforts, Branko?
Well, like targeted measures, like ones that I know, from my work, it's like, what happened to global poverty or global inequality. Obviously, for global poverty, we have had, tremendous success. Again, as Alan said, China is driver of many of these things. So if you take China out, however, I don't want to say that if you take China out, in the past, up to 2000, China practically alone was explaining all these changes. Well, things have changed a little bit now with the rise, actually significantly, with the rise of India as well. So we should, and then Indonesia, as I mentioned, also the other countries, Vietnam is a large country. So China is really a big part of the game, but it's not the full game anymore. Just, if I may just say one thing, which I see as a contradiction, and really the main problem that one faces there is that we have our incomes, many of us, and are determined globally and internationally, and this is all fine. But when you're actually affected, then there is really the only the only unit to which you can claim for compensation or your unhappiness is the nation state. So we have politically organized world in nation states, which then have to cover up for the lapses of globalization. So there is a little bit of this contradiction, and the nation states are then in a difficult position. They have really to sort of play the game, which is essentially determined by globalizing forces.
There's one interesting historical tidbit here. I used to be a historian. I said that kind of in the North Atlantic at least, between 1650 and 1800, you saw elites get nationalized. Then they spent 150 years of the welfare state in conscription, nationalizing the masses. What we're going through right now is a period where elites are globalizing, while the masses still remain national, at least in the Western world. But China and India are actually going through a process that's very much, to me, like what Western Europe went through between 1800 and 1950, kind of shared good fortune, increasing the sense of nationhood and of legitimacy. So there's a real phase problem here as well.
Does that mean this is a temporary transition to which there is some sort of end? And if so, what end are we moving to? Alan, I want to bring you in.
Well, one thing I think I would draw a distinction with the U.S. because the U.S. is more insulated than certainly Europe or Asia from these globalization forces, and trade makes up roughly 20% of our GDP. Our economy is domestically driven, and that's one of the reasons why I think you've seen the U.S. outperform Europe over the last 7-8 years. And I think that gives us some headroom to adjust to the more global environment. I don't think we've done enough. I think that we could have a much stronger system of trade adjustment assistance. I think the program that we really introduced as part of NAFTA, although it was around beforehand, is pretty effective bundle of services and income support for workers who are displaced from trade, but it's much too narrow. And the effects of trade, I think, are often indirect. So I think if we had a broader trade adjustment assistance agenda, I think that would help. And we do have the benefit of generating most of our own economic activity. It's not external demand in the U.S.
Karthik, you brought up culture before. Branko, I know you've been talking about some of the cultural tensions involved in the globalization debate as well. What role is there for policy given these tensions? Karthik, we'll start with you.
I mean, if what we're seeing is a more precarious workplace, to have a safety net that's tied to your place of work seems crazy. I mean, that's something, that's with healthcare, with a broad range of things. I suggest that's the first place to make a difference. That's.
Well, I would say actually going back to something that Alan mentioned before, when you look at sort of different indicators of globalization, one, we kind of often forget labor and see labor as kind of sort of an extra factor. But I think that factor, leaving aside refugees, war in Syria and all of that, which are one-off events, hopefully if the other wars don't develop. But I think actually the gap in incomes between Africa, which is demographically growing tremendously, and Europe, which on the other hand is not, or actually it is stagnant or declining, is going to be really a big problem for the next, I would even say 100 years. I like to say that in Europe, and people just sort of freak out. But for next 100 years, they will have to deal with this. It's a little bit different in the US because US had an experience of having been created and dealt with that for 3 centuries. Europe has always been a continent of emigrants, so they actually went around the world and conquered the world. Well, now actually it becomes a continent of immigrants, and I think culturally it's a very difficult thing, difficult adjustment for Europe to make. So I'm actually thinking of European problem being, in that respect, much sort of deeper than the American.
All right, so if globalization is moderating, if not necessarily ending, what does that actually mean for economic growth? Does it necessarily have to be a bad thing, Alan?
I think it probably is a bad thing in that the basic economics of trade, I think, are right, that expanding trade because of comparative advantage increases the size of the pie, raises productivity growth. People in different countries and businesses in different countries can specialize in where they have a comparative advantage, and I think that does, in the long run, contribute to rising living standards. On the other hand, as I said, in the US, we are less dependent on trade, so it will certainly have an effect, but I think there are many other things that we can do to counteract that effect. For example, we can invest more in research and development and innovation. We can improve our education system and make sure that children from more disadvantaged families have access to higher education. And I think particularly in a global world, it's important that workers are able to make a transition into new sectors, and that typically involves education and training. And there's a great opportunity because of the web technology, and I think the US has a great advantage there since we're so innovative and there's so much investment taking place in that area. And as Karthik mentioned, I think we have to look at our safety net and say, is it appropriate in the kind of system that we have, in the system where workers are increasingly responsible for their own careers, where more and more workers are freelancing, for example. And I think the Affordable Care Act is a very big step in that direction, where certainly isn't perfect, but workers can stay connected to healthcare providers without having to spend their whole career with one employer, and that should help them to be able to start businesses and strike out on their own because they can get coverage through the exchanges.
Well, let's dig into the policy response a little bit. And we covered some of this ground in the morning, but when you look at the policies of the 2 presidential candidates, Trump and Clinton, they take quite a different approach to globalization and its threats. How do you respond to those different approaches, and how do you weigh them? Karthik?
I mean, the Trump approach to me just seems like, let's undo this all. Let's pretend this never happened. I mean, I think my view is that would be enormously disruptive. I think from a human point of view, the fact that we've seen 600 million people from China get above the $2 a day line matters. What you do need to, to some degree, you have to have compensating mechanisms for the people who have been negatively affected by that. But obviously that brings enormous opportunities here as well. So, I mean, in some ways it's just an end to the politics of resentment and something more constructive, but that would be nice to see.
Branko, I'd like you to weigh in as well.
Well, no, I totally agree. I think actually it is also very difficult for me, at least, to see what is the sort of consistent story in Trump. And clearly, I think that Clinton would have clearly much better policies when it comes to globalization and even solving some of the issues of globalization, because I think there will be a movement, clearly movement towards helping some people, of course, increasing minimum wage, EITC, and all the other, and even sort of retraining and people helping people who are affected by trade. So I do see some consistency in what she is arguing for, and I cannot say that I see it in the case of the other candidate.
Just to add, because I think Branko and Karth have been much too generous to Mr. Trump. Policies that he's espoused would be horrific, not only for the U.S. but for the world, but particularly for the U.S. If we're going to tear up trade agreements in the hope of negotiating better ones, who's going to negotiate with us? It doesn't take much game theory to recognize that you lose credibility if you don't adhere to agreements that were negotiated in good faith in the past and long-standing. His understanding of what's affecting the U.S. economy and how it's performing is also out of touch with reality. I mean, he started the debate by saying jobs are fleeing the United States. Well, we added 15 million jobs since the beginning of 2010. And he spent a lot of those first 25 minutes or so criticizing NAFTA. And I worked in the federal government at the Labor Department when NAFTA was enacted in 1994. I don't remember a recession in 1995, 1996, 1997. In fact, the only time in the last 35 years that we saw income inequality come down in the US was in the late 1990s. I'm not attributing that to NAFTA, but certainly to say that it was the worst trade deal ever negotiated and caused problems for the US, I think is highly misleading. Then the last point I want to make is we think about trade agreements in an economic framework, and I think that's right, but there's also an international relations element. And if you look at credible estimates of the impact of NAFTA on the $18 trillion US economy, they're pretty small. One way or the other, they're pretty small. I think on net they're positive. I think we could have done a better job protecting the vulnerable, but they're awfully small. The first order effect is in advancing our international relations interests. And I think Secretary Clinton has been quite clear that she'll support trade agreements that lead to more jobs, higher incomes, and most importantly, in my view, promote our security interests. And that's why I think the President Obama has been right to talk about TPP in the context of preventing China from writing the rules and the threat that that would be to our interests in the area.
Well, I feel terrible that I have to shut down this conversation just as Alan really gets going. But we have a hard stop now. There's a break up until 3:30 or 3:35 or so, and then Jason Kelly will be back with Blackstone's Joseph Baratta. And before we go, can I just say that globalization might be moderating, but Bloomberg is globalizing its market's most influential conferences even further. We are going to be holding our first one in Abu Dhabi on December 7th. I will be there. I hope some of you at least will be able to make it as well. Thanks so much.
Thank you very much.
You're watching Daybreak Asia, coming to you live from New York, Sydney and Hong Kong. We're counting down to Asia's major market opens.
The top stories this hour, investors weighing concerns about China's economy and the pace of Fed tightening, surging UK inflation triggering a global bond sell-off. Fed officials seeing the need to scale back rate hikes at some point, with minutes of the last meeting showing concern about over-tightening. And Tencent reports its first ever revenue decline and cuts nearly 5% of its workforce, underscoring the extent of China's economic woes.
Take a look at U.S. futures under a little bit of pressure early in the Asian session, and this, of course, after a very volatile session in New York. We had the S&P 500 negative through most of the session, slightly higher after the FOMC minutes, but then plunging again. Really, the reaction was all over the place because we had the 10-year yield also near the 2.9%, but the 2-year yield surged and then pared back some of those gains, given that investors were perhaps thinking about the potential of smaller rate hikes at one point from the Fed. Not to mention that, of course, we're in the home stretch when it comes to U.S. earnings season. 4 out of 5 companies have beat or meet expectations, but today we also had Target sort of disappointing, so that really had a little bit of pressure on those retailers today. Crude prices under pressure in the Asian session after gaining a little bit of ground today, given that we had some bullish U.S. stockpile numbers, Heidi.
Yeah, we are just getting, of course, a steady stream of earnings here in Australia. Evolution Mining, the gold miner, full-year earnings just crossing the Bloomberg in the last few minutes. Full-year EBITDA coming in at 898.8 million Australian dollars. Net income for the full year at 323 million. A final dividend per share of 3 Australian cents. We did see expectations of both revenue and margins finishing the fiscal full year 2020 to ending June a bit lower versus a year ago. We had declining gold sales. I said that gold sold in fiscal 2022 ended the year down 5% from a year ago. We also had higher costs playing into that equation as well. Previously, we had seen higher gold and copper prices really helping cushion some of that broader revenue decline then, given that we saw average realized gold and copper prices actually up 2% and 12% respectively in the full year versus a year earlier, given we have seen some of that haven demand for gold as well as the supply disruptions playing into the copper price story as well. We'll get all of that and more with our exclusive interview with the Evolution Mining Executive Chairman, Jake Klein, who'll be joining us to talk through those results at 12:10 in Sydney, 10:10 in the morning if you're watching in Hong Kong. Let's get you over to how we're setting up for the market trading day. Belle.
Thanks, Heidi. Yeah, lots of earnings coming through for the ASX 200 today, including the ASX, of course, itself, but lots of good interviews coming up. So in terms of how we're looking, though, in the equity space, so we're looking a little bit weaker here. You can see the last close for Sydney, also Japan pointing to the downside here. What is really driving that is, of course, those Fed meeting minutes, particularly those concerns that we had from policymakers, the risk that inflation becomes entrenched. And we, of course, saw that as well coming through from the UK inflation numbers overnight, rising to the fastest level at the highest level in 40 years. China's economic outlook is another watch for us as well, not just in what we're hearing from the likes of Goldman Sachs, for instance, cutting their GDP forecast, but also in what's coming through in company earnings as well, because we saw Tencent posting its first ever revenue drop. Let's turn on, though, to take a look at what we're seeing in terms of global stocks as well, because we have seen a lot of optimism around the outlook. And you can actually see here that drop that we had in around June, July, we're up around 12% since then. But the question really is whether this can be sustained. And when you take a look at the relative strength here as well, you can see that we're actually nearing very close to that key 70 level. And Sherry, of course, you've also got to mention that trading volumes have really fallen off a cliff here, well below their historical norms. So that also makes us more sensitive to any sort of economic readings, including, of course, those Fed meeting minutes.
Yeah, also watching the Nikkei, the overbought levels now surpassed at that 71 or so. Waiting for the open and the market reaction, of course, from the FOMC minutes as well, as Belle mentioned, because they were perceived as perhaps slightly less hawkish than expected. But let's discuss. Global economics and policy editor Kathleen Hayes and cross-asset Asia editor Andrea Papel. Kathleen, I mean, the markets tend to these days